Hi, it's Joe, your Lehigh Valley real estate economist with the latest news. The Federal Reserve made news again last week by lowering the bank rate by a quarter point for the third meeting in a row. And now people are wondering why mortgage rates haven't dropped accordingly. That's because mortgage rates are not directly tied to the Fed rate. Sure, there's some influence there, but nothing you can really tie a number to. That's why if you're looking for a real indicator of mortgage rates, you look for something called the 10-year Treasury yield. For over 50 years, the 30-year fixed mortgage rate has closely followed the movement of the 10-year Treasury yield, which is a widely watched benchmark for long-term interest rates. When the Treasury yield climbs, mortgage rates tend to follow. And when the yield falls, mortgage rates typically come down. It's been a predictable pattern for over 50 years now, so predictable that there's a number experts consider normal for the gap between the two. It's known as the spread, and it usually averages about 1.76 percentage points, or what you'll sometimes hear called 176 basis points. Over the past couple of years, though, that spread has been much wider than normal. Why? Well, think of the spread as a measure of fear in the market. When there's lingering uncertainty in the economy, the gap widens beyond its usual norm, as you can see on the left. That's one of the reasons why mortgage rates have been unusually high over the last few years. But here's a sign for optimism. Even though there's still some lingering uncertainty related to the economy, that spread is starting to shrink as the path forward becomes clearer. You can see it's now down to right around 2.25 points. It's not just the spread, though. The 10-year Treasury yield itself is also forecast to come down in the months ahead. So when you combine a lower yield with a narrowing spread, you have two key forces potentially pushing mortgage rates down going into early to mid 2026. This long-term relationship is a big reason why you see experts currently projecting mortgage rates will ease. Here's how it works. Let's take the 10-year Treasury yield, which is about 4.9% at the time this graphic was made, and then add the average spread of 1.76. From there, we'd expect mortgage rates to be around 5.85. But remember, all of that can change as the economy shifts. And know for certain that there will be ups and downs along the way. How these dynamics play out will depend on where the economy, the job market, inflation, and more go from here. But the 2026 outlook is currently expected to be a gradual mortgage rate decline. And as of now, things are, well, more or less moving in the right direction. Keeping up with all of these shifts can feel overwhelming. That's why having an experienced agent and lender on your side matters. We'll do the heavy lifting for you. If you want real-time updates on mortgage rates, let's connect so you have someone to keep you in the loop and help you plan your next move or let you know when is the right time to refinance.